Let's dive into the Federal Reserve's funds rate and why it's such a game changer for the economy and investors. Think of it as the cost banks pay to borrow from the Federal Reserve. When the Fed raises this rate, borrowing money becomes harder and the money supply shrinks. Why? To keep inflation in check. Inflation happens when there's too much cash chasing too few goods and prices start climbing. Here's where the domino effect kicks in. Banks borrow less from the Fed, so they hike up rates on loans, credit cards, and mortgages. Suddenly, borrowing costs more for everyone. Consumers have less cash to spend, businesses bring in smaller revenues, and borrowing for growth gets pricey. As businesses cut back on spending, profits shrink, and growth slows. And investors, they feel the pinch too. Lower profits mean companies have less estimated future cash flow, which pushes down stock prices. A falling market isn't what most investors want. Plus, lower growth expectations make stocks riskier, and when the risks go up, investors demand a higher return, what's known as a risk premium. But here's the twist. A higher federal funds rate also boosts interest rates on safe investments like treasury bonds, suddenly making them more attractive. So whether you're a saver or an investor, the Fed's decisions ripple through the economy, shaping how we borrow, spend, and invest at every level. Understanding this helps you stay ahead of the curve.